Yeah, I mean, if you want to simplify it in its simplest form, really, there is a funnel, and water gets poured into that funnel. The water being poured into that funnel is all of the capex from the big tech companies. Okay,
Mm.
Microsoft, Amazon, la da la da da. $380 billion is being poured into this funnel this year. That money flows down the funnel and percolates throughout the AI complex.
Hello and welcome to Being Exponential with Luke Lango, where we'll go over the economy, the markets, technology, and lifestyle, all from an exponential perspective. I'm your host, Brooke. It is November 4th. Let's dive right in. All right, Luke, I want to start this episode off talking about earnings. So typically, I'm the voice of pessimism when it comes to the AI boom that we've been experiencing, but it is hard to contradict some of these numbers. A big chunk of the Magnificent Seven reported their earnings last week, and the numbers were great across the board. However, we did see some dips in Microsoft and Meta after they reported, due to a number of factors there. But the market's a little choppy right now. But I want to get your insight into the numbers that we saw last week, and your projections on what we'll see in the future.
Well, Brooke, first things first, shout out to the Los Angeles Dodgers
Right,
for
right.
winning the World Series, first back-to-back champion since the Yankees in the late 90s, over 25 years. What a series. Tip of the hat to the Blue Jays. A lot of great games. Went the distance, game seven, and went extras in game seven. So even if you don't like baseball, you gotta love what's happening in the MLB right now. Some really, really exciting stuff. And on that note, even if you don't like artificial intelligence, you got to really respect some of the numbers that these big tech companies are putting up. Meta, Alphabet, Amazon, Microsoft, Apple, Palantir. These companies are collectively putting up some of the best numbers I've ever seen from companies of that size. Like these are companies, when you get law of large numbers, when you get really big, you shouldn't grow that quickly. But these companies are massive already, and they're growing as quickly as they have in several years. Meta, for example, let's just go through it kind of one by one, right? Meta beat on everything. Revenues were up 26%. This is a company that already owns the entire social media space, a company that owns a big chunk of the digital advertising world, a company that's been around for a long time, is already doing a ton of revenues, is already has a massive valuation, and they're growing revenues at 26%. I mean, that's the best growth rate, revenue growth rate since early 2024. Ad revenues up 26%. That's the best since early 2024. Reality Labs, shout out to the glasses, up 74%, which is the best quarter for that business, I think, that business segment ever. Now, what's driving the growth at Meta? It's AI. AI is improving the content on our feed, so people like you and me are spending more time on those feeds, which is ridiculous. If you consider you and I, the average person, how much time we as a society already spend on platforms like Facebook and Instagram and Reels and all this stuff. Yet still, the time spent on Facebook in the quarter increased 5%. So what's already a ubiquity and what's already something that is a massive time taker is seeing time go up even more. Engagement on Instagram video, time spent on Instagram video was up 30% in the quarter. So that's ridiculous, and that's all AI. The AI algorithm knows you better than you know you. It's giving you the content you like to watch, so you're spending more time on the platform. The more time you spend on the platform, the more advertisers are like, oh, I want to be on that platform. So you're getting an ad boost there as well. Not to mention, they have that end-to-end automated ad platform, right? The whole thing that Zuck wants to do is automate the entire ad process. So you just go to them with, I want to sell X. You put it into their AI ad platform, and then boom, it's automated all the way to the end result, to the customer finding your product and buying your product. I think a whole bunch of ads are being fully automated like that, and they're performing really well. So you're seeing an increase in conversion rates, you're seeing an increase in average revenue per user, and you're seeing 26% revenue growth, best revenue growth in since early 2024. So really great stuff from Meta, in my opinion. Yet the stock dropped. Why? Because people are concerned about them potentially overspending. But given the results, I don't think they're overspending. I think they're doing everything just right. You go on to Alphabet. Also, massive beats across the board. Okay. You look at revenues up 16%. Also, the best since, let's see, early 2022. Essentially a 3-year high revenue growth rate. That's absurd. Law of large numbers. As you get bigger, you're supposed to grow more slowly. They're getting bigger and growing more quickly. Revenue growth 16%, best since early 2022. Fantastic. Google search, we can kill that fear that AI is going to end Google search, that ChatGPT is going to take over Google search. No. Google search revenue is up 15%, 3-year high revenue growth rate there. Search is clearly defending its turf. YouTube revenue is up 15%, also multi-quarter high. And Google Cloud, the big kahuna there, up 34%, accelerating even more. And yes, a multi-year high growth rate on that business. So really good stuff there. You're seeing AI cloud compute demand continue to exceed AI cloud compute supply. You're seeing Alphabet use AI to deliver positive ROI for their advertisers, for their own internal businesses. Profit margins are going up, excluding some fines and stuff. So really good stuff out of Alphabet. Amazon, same situation in my opinion. Big beats across the board. The retail business, not doing so well. We'll talk about that in a little bit, but AI, the cloud business, AWS, absolutely on fire. 20% revenue growth, accelerating there. Again, accelerating AWS. This is the biggest cloud business in the world, and they are accelerating in their growth rates. That's sensational. It's the first time they've actually accelerated AWS growth rates in over a year. And it's the fastest AWS has been growing since 2022. So 3+ year high on AWS growth rates. And the backlog is surging. I think over $200 billion backlog for AWS now. Massive deal volume in the quarter. They're adding more capacity and they're going to keep on spending. Same story over at Microsoft, right? You did see Azure. They put Microsoft numbers. They beat on everything. They gave a good guide. Revenues up 70% in constant currency, stable at, once again, multi-year highs. Azure up 39%, also stable at multi-year highs. Fourth quarter guide for about 37% growth there. So just really good stuff over there. Microsoft Cloud RPO, remaining performance obligations, up 50% to nearly $400 billion. Commercial bookings up 111%, 111% in constant currency. And they're going to keep on spending to build more AI data centers as well. So when I look at these reports, I see nothing but strength. I see companies that are delivering on the promise that AI is going to supercharge their businesses, both for making a better consumer product and accelerating revenue growth, as well as unlocking internal efficiencies and expanding profit margins. The mixed stock reaction is a byproduct of fears that in order to drive these really good top line results, these companies may be spending too much. That's what you're seeing. Those are the fears out there right now. Meta, for example, operating margins compressed this quarter for the first time in about 3 years, I think. Operating profit growth, EPS growth, not so hot over there. Microsoft's margins, a little bit of pressure. Amazon's margins, not a lot of pressure, but a little bit of pressure. Alphabet's margins, a little bit of pressure. There were some fines in there, but still some pressure. The capex guides from all these guys, from the big four, Microsoft, Amazon, Alphabet, Meta, 2025 capex guides were lifted. 2026 capex guides, the implied guides, were lifted. So they're going to keep on spending. They're going to spend even more. The AI capex tidal wave is going to get bigger and expand even farther over the next 12 months. The concern, again, is that they're overspending to drive this big growth. I do not think so. And I cannot be more adamant in saying I do not think that they are overspending. When you have a market that is structurally undersupplied, AI cloud compute demand is significantly outpacing AI cloud compute supply. when you have a market that is structurally undersupplied and a market that once the supply is there to meet the demand, you are seeing ROI on all the spend to increase the supply. Again, Meta, greatest feed ever now in terms of content. The ads are better than ever. They're delivering to advertisers better and more meaningful, more measurable results than ever before. Same thing over at Alphabet. Amazon, they're seeing massive demand growth for AWS. Microsoft, they're seeing huge growth in all things AI over there. And you talk about Palantir. This is why Palantir's report is super important. Palantir is the end market demand for AI, right? They sell the software that not you and I, but that the companies we work for buy, that the biggest companies in America buy. That's the end market demand for AI. And they had a great quarter. I mean, I know the stock dropped because of valuation friction and whatnot. I think that's complete BS. Don't listen to that. Double beat and raise report. Revenue's up 63%, 9 straight quarters of accelerating revenue growth at Palantir. The fourth quarter guide is for 61% growth, which, yes, is a slowdown, but they always beat their own guide. So realistically, we're talking growth probably north of 65%, which means 10 straight quarters of accelerating growth at Palantir, which means basically ever since ChatGPT launched in this AI era, Palantir every single quarter after quarter has seen accelerating growth. So not only great growth, but accelerating growth. Things are improving. The end market demand is strengthening. That means there's ROI on the spend. That means that all this money that Microsoft and Amazon and Meta and Google are spending to build these AI data centers, on the other side of that spend is enormous demand, is 9 straight quarters, 10 straight quarters of accelerating growth for Palantir, revenue growth of over 60% in back-to-back quarters. There is ROI. So I do not share these concerns that these companies are overspending. Yes, Meta is going out and hiring AI engineers like their Shohei Ohtani. Shout out Shohei Ohtani, to these massive contracts, but it is worth it because they are creating a platform that is better than ever, that is optimized by AI. And it's only that way because of all this spending, because of the AI capabilities, all this spending is unlocking. So I'm not concerned about the overspending concerns that are out there. What I am a little bit concerned by is when you do have all these reports and you get these beat and raises. I mean, look at Palantir beat and raise, but the stock dropped. Uber beat and raise, but the stock dropped. Shopify beat and raise, but the stock dropped. BWX Technologies, the nuclear equipment supplier, beat and raise, but the stock dropped. Monolithic power management supplier for AI data centers. Q3 beat and raise, but the stock dropped. These are, I mean, you see the theme here, right? These are double beat and raise reports. They're doing everything that they should be doing, yet the stocks are not reacting positively. That tells me the market's a little bit fatigued. That tells me there's some buyer fatigue out there. But it does not tell me, we've talked a lot about an impending crash coming, in the next 1 to 2 years, there's going to be this big AI reckoning, this big AI stock market crash, the bubble's going to pop. This is not that. This is just a reset. That's going to happen when the underlying facts change, when the underlying trend of growth in AI changes or slows or stalls. That's not what we're seeing right now. The underlying facts remain positive. Beat and raises across the board, accelerating growth across the board. The trend of growth is amazing. And the top of the funnel, which is big tech spending, big tech capex, Microsoft, Amazon, Meta, Alphabet, big four. I mean, go back to my numbers. I think they're going to spend about $380 billion. Let me get the exact numbers for you. Based on my estimates, based on the updated commentary, they're going to spend $380 billion, about $380 billion on AI capex in 2025. That's a shit ton of money. 2026, they're going to spend over $510 billion, up 34% year over year. So this AI capex tidal wave that is the top of the funnel, which is creating growth for all of these companies, from Monolithic Power to Fabrinet to BWX Technologies, that top of the funnel, the amount of money pouring into the funnel is going to increase by 34%, at least 34% next year, which means this whole AI boom is not over. What we're seeing right now is a reset on valuation friction, valuation concerns. all that stuff. And I get that, Michael Burry's back out here tweeting against these stocks, and the CEO of Goldman Sachs and Morgan Stanley and Capital Group they're all out there kind of saying valuation, valuation, valuation. But let me tell you one thing about valuation. Avoiding stocks because of rich valuations is the most expensive and costly myth on the planet. We did an analysis on this. We looked at, and I'll share this chart with you, Brooks, so you can post it up for people. We ran an analysis on, okay, how do stocks perform across different valuation levels? Specifically, if the market is super richly valued, are the forward returns on the market itself better or worse than when the market is not super richly valued? Well, get this. Every single time that the S&P 500 has been trading north of 25 times forward earnings, a really expensive valuation where we are today. Every single time it's done that, going back to 1990, that's when my data goes back to 1990, the forward 3-month returns on the S&P 500 were higher than all other time periods. The forward 6-month returns on the S&P 500 were higher than all other time periods, and the forward 12-month returns on the S&P 500 were higher than all other time periods. Specifically, you're looking at 3.7% average forward 3-month returns versus 2.4% for all time periods, 9.9% plus 6-month versus 4.8% for all other periods, and 18.2% average forward 12-month returns for when the S&P 500 is trading below 25 times forward earnings versus 10% for all other time periods. So as it turns out, Mr. Market isn't stupid, right? When stocks trade at elevated valuations, it is usually for a good reason, and that good reason is strong earnings growth. And that strong earnings growth provides a catalyst for stock prices to move even higher. So valuations, like eventually it's going to matter once the earnings growth stops showing up to the party. But for right now, the earnings growth is showing up to the party. Right now, the bartender is still pouring shots. Right now, we are in the 11th inning when the Dodgers are about to win the World Series. Right now, we are in the exciting part of the game, and I do not think this is the crash or the reset that ends this boom. Instead, I think we're just in, again, like I said, a healthy little valuation correction, find some support at the 50-day moving average probably, and then we bounce higher. I would take this recent volatility as an opportunity to add exposure to the AI complex. That's my very long-winded intro to this podcast.
Definitely. No. Much needed to ease some of the concern there. I think, people are still emotional when it comes to the market. But I did want to reiterate something you said a little bit earlier regarding the law of big numbers. It's just, we got to emphasize how big these numbers are. Take NVIDIA, for example. In July is when they hit 4 trillion. They just hit 5 trillion. And what is that? A quarter? Only 11 other companies have hit $1 trillion evaluation. NVIDIA did it in gained that much in under a year.
Yeah.
And Jensen Huang himself said that we don't have the supply for all the demand. So like the money is going to keep coming in. So just like your thesis here is like that the boom is still going to be keep going.
Yeah, I mean, if you want to simplify it in its simplest form, really, there is a funnel, and water gets poured into that funnel. The water being poured into that funnel is all of the capex from the big tech companies, okay? Microsoft, Amazon, la-di-da-la-di-do. $380 billion is being poured into this funnel this year. That money flows down the funnel and percolates throughout the AI complex. That money turns into money for Veritiv, for cooling equipment, for Monolithic Power, for power management systems, for Bloom Energy, for on-site backup power at these data centers, for Constellation Vistra, for providing power to these data centers, for NVIDIA AI accelerators and AMD AI accelerators, for Marvell and Broadcom for custom silicon, for Lumentum for optics, for Sienna for networking, for Pure Storage, Micron, and Western Digital, WDC, for memory that goes into these data centers. That money, again, it flows down the funnel and percolates throughout the entire AI complex. So as long as the money continues to flow into the funnel from the top, the big tech companies continue to pour their massive jug of water into this funnel, the growth will persist. Big tech will do that, will continue to do that, at least for the next 12 months, for two reasons. One, they said they're going to. Again, AI estimated capex among those big four this year, 380 billion, next year, about 510 billion, up 34% year over year. So not only are they going to keep pouring money in the funnel, but they're going to actually get a bigger jug and pour that into the funnel. And then number two, they're going to keep doing it because the ROI is there. It absolutely is there. Again, Meta, Alphabet, their advertising businesses are operating at the best they've ever operated. They're growing users, they're growing engagement, they're growing ad performance. I mean, these things are optimized by AI. Amazon, its retail business is being optimized by AI. Its logistics business is being optimized by AI. Microsoft, that whole cloud business is absolutely on fire. Copilot is growing like crazy. Let me just read some of those Copilot numbers are absolutely insane for Microsoft. They have over 900 million monthly actives of its AI features, 150 million Copilot MAUs. That's up 50 million quarter over quarter. That Dragon Copilot, which is their health thing, has observed 17 million patient encounters in the quarter, up 5 times year over year. 80% of the Fortune 500 uses Microsoft 365 Copilot. Over 90% of the Fortune 500 uses. Oh no, wait, that's 365 Copilot. AI Foundry has 80% of the Fortune 500. So I mean, they're seeing huge growth, just like Palantir for enterprise AI software. The ROI is absolutely there. So from that perspective, the money's going to keep flowing in this funnel. That money is going to percolate throughout the AI complex, and the companies that have been winning that money will keep on winning that money. They'll keep on winning contracts, and that's why when I see a company like Monolithic Power drop 10% on earnings that were really, really, really good, and the money's still flowing for them, I say buy that dip, right? That's what we're doing right now. Is we're actually looking throughout the AI complex, this AI infrastructure supply chain, and saying, okay, what's been stupidly sold off in the last 2 to 3 weeks that is now at really strong technical support levels, which is still supported by really strong fundamentals and now features compelling valuation. Those are going to be the ones you want to take action on right now. So that's our viewpoint. We think everything is right and dandy right now, and that stock's well bounced back pretty nicely. Though admittedly, it's been a pretty rough week or so, I would say.
Yeah, that definitely some dip in the markets there. I think is it hyperbolic to say, Luke, that we have this K-shaped economy, but within that growth portion of the economy, we almost have this inversion where these huge companies are almost performing like small cap stocks. Like some of those numbers you railed off are pretty crazy for plus $1 trillion companies.
Because those large companies are eating the small cap stocks.
Right.
I mean, the S&P 500 equal weight relative to the S&P 500 is, I think, in its lowest level since 2003. Like, this is not a market, a rising tide lifts all boats situation at all. It's a rising tide lifts the AI complex and screws everything else. That's the K-shaped economy, right? These large caps are acting like small caps, so the small caps aren't doing diddly squat. There's no money moving into the small caps, so it's all going into the large caps. Everything is flowing into the AI complex because, again, all this money from big tech is flowing into the AI complex in terms of business dollars, right? Revenues and
Yeah.
contracts and deals. Well, the investor money is just chasing that money. So now you have this massive allocation, concentration of money, both business money and financial market money in one corner of the economy of the market. And that's the K-shaped economy. Really interesting results we got this week were from Lifetime, the stupidly expensive gym membership or gym operator. Lifetime, for those that don't know, is a luxury gym that sells, once again, stupidly expensive gym memberships. And guess what? They reported great earnings this week, meaning they are selling more of those stupidly expensive gym memberships, and they're increasing the prices of those already stupidly expensive gym memberships, make them even more stupidly expensive, and the rich people are absorbing that price hike without a hiccup. Members rose 2%. Average price per member, or average dues or whatever, went up 11 or 12%. Really good revenue growth over there. Comparable sales per gym up 11%, and that stock went up. That's the K-shaped economy. Meanwhile, last week, Shake Shack and Chipotle are reporting miserable numbers because they're saying the lower income consumer can't even afford to eat out. So the lower income consumer can't afford to eat out. They're BNPLing burritos. Chipotle and Shake Shack are getting hit hard. Kava's getting hit hard. Dutch Bros is getting hit hard. Starbucks is getting hit hard. But then rich people are paying $5 bajillion a month for a lifetime membership in a spa, and that's going up to 10 bajillion a month, and they're like, whatever, because they're in the AI economy and they're making all the money. That's the K-shaped economy, man, and it's playing out like crazy right now. The rubber band is getting stretched really, really far. I don't think it's at a breaking point, like I've said before, but we're seeing the signs, right? This earnings season is confirming we are definitely in a K-shaped economy. There's no argument against it.
All right, so switching gears here, Luke. Jerome Powell and the Fed dropped the rates by 25 basis points, and they said for December the outlook is uncertain. They said they're waiting for the data to come out before they make any strong decisions or even hint at a cut at that time. So now, what do you make of that, Luke? And how do you think that's going to affect the markets going forward?
Listen, I used to think the Fed was the master of the financial universe, and I still do to an extent, but temporarily they've lost control. Temporarily they've lost the plot. This is not political. I'm not saying Jerome Powell's out to lunch. I don't think he is. This is not saying, Trump's trying to warp the Fed so they've lost their power. I don't think that's the case either. It's just, I think they have no idea what AI is going to do to the economy. Um, Powell was asked a few questions at the meeting last week about how AI is impacting things and how that might change Fed policy, and he didn't really answer them in a manner which suggested that he had a grip on what's going on. And I don't expect him to, okay? Not to like stereotype people or typecast people, but he's an old white man who has been studying a certain type of economics his entire life. AI is this new thing that's come up in the eighth inning of his career. He's not going to change the way he looks at things because something changes in the eighth inning of the career. He's sticking with the game plan he had for 8 innings, right? So I don't expect him to, nor do I expect anybody on the Fed really to, nor do I expect anybody out in the world really to. I study this stuff all the time. I still don't know what AI is going to do to the economy. I don't
Right.
know what it's going to do to the labor market. I don't know what it's going to do to productivity. I don't know what it's going to do to wage gains. I don't know what it's going to do to blue collar or white collar work. I do not know. And so I think we have to just admit we're all flying blind right now. We are looking at a force, artificial intelligence, that is going to profoundly change the landscape of our economy. It's going to change the rules of our economy. And no one really knows exactly how. So the Fed can cut rates or raise rates or do this or do that, but all of it's going to change once we realize what AI is actually doing to the economy. And that's why I think the Fed has temporarily lost control of the market. I don't think they're the masters of the financial universe anymore. The masters are big tech, right? Big tech is
Yeah.
driving the market. Big tech will, because they're driving AI, and AI is all that matters. So, from that perspective, whether the Fed cuts or doesn't cut in December, I think is largely in a multi-month window irrelevant to the markets. I think in a multi-week window it'll matter if we don't cut. If they don't cut, we're going to see a big sell-off, probably on the order of 5 to 10%. Okay, but I think we'll rebound right from that because the big tech spending will continue. Big tech spending is mostly cash finance. It's not reliant on rates. Where it is reliant on rates, they don't care what rates are. If rates go up 25 basis points, it's not going to stop big tech companies from spending or levering up on AI. They're convinced this is the future. They're seeing great ROI on that. This is the one thing that Powell did acknowledge. The AI capital boom is not particularly interest rate sensitive, and I would say it's not at all interest rate sensitive. So, again, from all these perspectives, I just don't think the Fed matters as much as they once did. They will matter again at some point, but for now, looking out over the next 12 months, I don't think they matter all that much. I think they are going to cut rates a few more times, whether they cut rates one more time or five more times. I don't think it matters for the market. It's going to matter for the lower income consumer. It's going to matter for the lower part of that K. It's going to matter for some markets like housing, like auto, but it's not going to matter for the broader stock market, and it's not going to matter for the general AI complex or the upper part of the K in the K-shaped economy. All it is going to matter for is kind of like, little one-offs here and there. That's my view on the Fed right now. And again, this is coming from somebody that I have long respected the Fed and long seen them as the masters of Wall Street. I don't think so anymore. At least for now, that's temporarily changed because AI has changed the game.
Yeah, roger that. Yeah, I mean, what can the Fed say to Nvidia, which is probably in terms of GDP, like the third, fourth biggest country? It's kind of nuts, but I think it will be interesting once this shutdown is over. Ideally this week. I mean, even if it is over this week, it will be the longest running shutdown, and then we start getting that BLS data. So December might be interesting in terms of that.
Yeah, I mean, ultimately I think they do cut. I don't think they're gonna hold off. I just think that there is enough, even if the shutdown persists, and even if we don't get BLS data, new BLS data by December, which I think would be a long shot. Like
Yeah.
we should get BLS data by December, but even if we don't, there's enough alternative data out there to show that the labor market is massively weakening. Indeed, job openings is something that job postings is something that is proven to be a very good leading indicator of the official job openings data, the JOLTS report, which we were supposed to get today and we didn't. But that continues to decline. So job openings are obviously falling. We're getting all these layoff announcements.
Mhm.
Amazon's embarking on its biggest corporate layoff ever, right? 30,000 corporate layoffs, I think,
30,000, yeah.
over at Amazon. And again, that's the juxtaposition of this K-shaped economy, right? You have Amazon stock at all-time highs, just reported blowout earnings. The market rewarded it very handsomely, accelerating AWS growth, very strong growth in its retail business. That's juxtaposed against them doing the biggest corporate layoff in the company's history. That's wild, right? I mean, historically speaking, companies don't do layoffs when times are good. They only do layoffs when times are bad, when push comes to shove. So that's what really scares me about when we do get to that push comes to shove moment.
Mhm.
I mean, if they're already doing the biggest corporate layoff ever and the stock's at all-time highs, how much pressure is the management team going to face from the board and from shareholders when the stock's down 20, 25% because of some AI crash? How big's that layoff going to be? Right. So that's what worries me about that when we do eventually crash, which again, I don't think is happening now, but will happen in the next 1 to 2 years. When we do eventually crash, it could be a really bad crash because of the layoff dynamic that we just talked about.
Gotcha. Now, speaking of other risk factors regarding an impending crash, I want to bring up M&A and IPO activity. So, with
Hmm.
IPO specifically, have been almost 300 this year so far, and that's up
Yeah.
50% from last year. So,
Yeah.
we both recall you mentioning a frothy IPO market is a telltale red flag. So, what do you make of that data, Luke?
Yeah, frothy IPO market and a frothy M&A market. When those two markets really heat up, that's a contrarian signal, right? Now,
Mhm.
I've been looking a lot at M&A volume recently because there's been a ton of
Yep.
M&A activity in the last week or so. We had Kimberly Clark look. They bought Tylenol maker Kenvue, the company that's been destroyed by RFK Jr. They bought them for $40 billion in cash and stock. Eaton Powers bought Boyd Thermal from Goldman Sachs for $9.5 billion. I think um, SM bought Civitas Resources for $2.8 billion. There's been a lot of M&A activity in the last 2 weeks, and the result of that is that November month to date in November, we're over $90 billion in M&A volume. If that persists, we're going to be at $900 billion by the end of the month, and that would be an all-time high. That would be a record. And that
Mhm.
follows September 2025 deal volume was 673 billion. October 2025 was 573 billion. These are among record highs. If we get to 900 billion in November 2025, that would be a record high. So we are seeing a massive heat up in the M&A market. Not a great sign.
Right.
Just put simply, not a great sign. Now, this is a leading indicator. So there's a multi-month lag between when the M&A market tends to peak out and when the stock market tends to peak out. Specifically, looking at my data here, M&A volume peaked in November of 1999. The S&P 500 didn't peak until August of 2000, 9 months later. M&A volume peaked in April of 2007. S&P 500 didn't peak out until October of 2007, 6 months later. So there is a multi-month lag between M&A market going woo and the stock market going woo. So I'm not saying because M&A is heating up right now, the crash is right around the corner, but this is yet another indicator to suggest that yellow flags are being waved, and within the next year or two, we will get a pretty big crash. That's not happening now. I don't think that is happening now. But yes, looking at the M&A market and the IPO markets, we are seeing signs that froth is building. And some of these deals, a lot of them are cash, but a lot of them are stock and a lot of them are debt. Those are the deals that can blow up. And when those deals blow up, everything else blows up with it. So it normally takes a couple. That's why it takes a couple months, because you get this massive spike up in M&A volume. These deals happen, and then a couple months later, the deals don't pan out, and the stocks collapse, and that's when the cockroaches come out. So that's why it takes a couple months between the M&A peak and the stock market peak. And right now, we're seeing the deals be announced. Then the deals have to happen, and then the deals not have to not pan out. So that's that's a 9 to 12 month period. And that's why I think, again, the ultimate crash is still about 12 months out, but it is coming. It absolutely is coming.
Roger that. Okay. Now, in the meanwhile, we do have a buying opportunity of sorts. So
Yeah.
I want you to point us in the right direction. Let's start off with that rare earth magnet metals
Right.
market. We had some headwinds there because of the agreement between China and the U.S. It caused a dip, and then we have the dip here. So, what's the stock to look at in that particular sector of the market?
Yeah, so I really like the proposition on buying the dip in rare earth stocks right now. MP is obviously the big dog in the space. I really like the dip buying opportunity there. But a couple other names: USA Rare Earths, Trilogy Metals, Critical Materials, CRML, NB is another one, TMC, United States Antimony, UAMY. I think all of these stocks look good here, though I think MP looks best. I mean, the deal is okay. These stocks got a massive boost because the U.S. wants to build out its own domestic rare earth supply chain. Cool. But now they're retreating because the U.S. and China have struck some peace deal where the rare earth problem, according to Trump, is completely gone. That's what he told 60 Minutes on Sunday. It's completely gone. Okay, whatever. I don't care what U.S.-China relations are. Like, whether they're good, whether they're bad, whether they're fighting, whether they're making love, I don't care. Those relationships are completely irrelevant to, or should be completely irrelevant to, America's pursuit of building its own domestic in-house supply chain for rare earths. Because you do not rely on your competitor to provide you with the critical material you need for the thing you are competing with that competitor on, right? Like that would be like the Lakers relying on the Celtics to give them basketballs for the whole season. You don't do that. The Lakers buy their own basketballs, right? You can't rely on the Celtics to provide basketballs for your practice sessions in LA. That would be like the 49ers relying on the Chiefs to give them footballs for their
Mhm.
practice sessions all season long. You don't do that. You don't rely on your competitor to provide you the equipment you need to just play the damn game. So why on earth, the Lakers buy and bring their own basketballs. The 49ers buy and bring their own footballs. The Dodgers buy and bring their own baseballs. America needs to buy and bring its own rare earths. It needs to mine their own rare earths and make their own magnets for rare earth magnets, right? Like, that's what you have to do. So I don't care if Trump and Xi are getting along. I don't care if the U.S. and China are at war. regardless of how those relationship patterns play out or evolve, and they're going to be very volatile, we need to invest in our rare earth supply chain. We need to build out MP. We need to have really big growth in that industry. And so that's why I think, hey, these stocks are dropping because the US and China are at peace again. So what? Who cares? Now I
Right.
get from a trading perspective, yeah, I get, there's catalysts that send stocks up and down, and this is one that's sending them down, but it's going to reverse course also, right? Every single peace deal between the US and China has gone south in the last, 5,000 years. So like you just have to understand this one's going to go south too. And when it does go south, these stocks are going to get a big rally in the short term. And so I think you're going to get, a rebound on that. But I mean, just zooming out, I don't think they should go higher on that. And I don't think they should go lower on this. They should just go higher because the US will continue to support and invest in building out a domestic rare earth supply chain. So I really like the setup on MP. I really like the setup on USAR and a few other names in this space where they've just been completely wiped out on a fear that is, I think, inconsequential to the long-term growth trajectories of these companies.
Yeah, 100%. Much agreed there. And then I want to switch to another sector. Let's talk about energy and nuclear specifically. I was sad to see my Akla holdings dip a little bit, but this seemed you're iterating that it's time to buy that dip. And what other companies should we be looking at there as well?
Yeah, so I mean, BWXT put up a really good report. That's a company that's in the space. They provide equipment to nuclear reactors. They delivered a double beat and raise report. Government revenues up 10%, commercial revenues up 122%, overall revenues up 29%. All of those are at multi-year highs. The management team came out and said that the demand environment for nuclear energy is absolutely unprecedented at the moment. One of the biggest demand drivers, one of the biggest verticals for growth is indeed AI data centers. They said the micro reactor environment is evolving very positively. So there goes to your Oklo holding. There's a lot of good stuff going on in the nuclear space. The BWXT report confirmed that. So I look at a name like Oklo, I look at a name like BWXT, I look at a name like SMR, I look at a name like LEU, I look at a name like, at the bigger level, the IPPs, Constellation and Vistra. These are all stocks I want to buy in the dip. These are all stocks that I'm going to wait for them to come to some technical support. As soon as they show technical support, I'm going to buy them on a bounce. One of my rules of thumb is don't catch falling knives, but be ready to buy bouncing tennis balls, right?
Right.
Like don't catch the stock as it's falling. Don't try and time the dip, but as soon as it finds support and it bounces, have that capital ready to deploy on the bounce. Buy the bounce, not the dip. So as soon as these stocks start to show some support and bounce, they're the names you want to buy. That complex is in a really good position right now because remember, money flowing in the funnel. You build all these data centers, you need power. I forget who it was, if it was the Amazon CEO or the Microsoft CEO. One of the CEOs of the big tech companies last week said the biggest bottleneck is energy right now. The biggest bottleneck is power. We need more power. OpenAI wrote an open letter to the White House saying, please, 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 please commission more power. And the White House, I think, is listening, and they're cutting red tape to allow for more regulatory hookups to the grid. So I just think there's a lot of good stuff happening here. This is a secular growth story. I really like the nuclear complex on this dip alongside the rare earths complex on this dip.
Awesome. Yeah, I mean, with all that demand, wouldn't it be safe to just DCA that the energy or the power complex and not
Oh,
even worry?
I think you want to DCA the whole this anything in this funnel. Okay, we got the funnel. Anything that's the whole AI complex. One offshoot is the energy complex. One offshoot is the rare earths complex. One offshoot is the chips complex, the semi equipment complex. DCA all of those complexes,
Yeah,
complexes.
complexes. Yeah, let's go with
Wow,
that.
that's pretty complex, isn't it?
Right.
In any event, you want to DCA into all that until the money stops flowing, until big tech stops pouring its jug of water into this funnel, until that stops, you want to DCA into all the companies exposed to that funnel, exposed to this massive AI capex super cycle. DCA into the energy, DCA into the and then within energy, obviously, solar and wind are having kind of a moment. I still hate them. Nuclear and batteries are the way to play it. Okay, I think the future backbone of energy in for AI in the United States is nuclear plus on-site energy storage, whether that's fuel cells, Bloom Energy, or batteries, Fluence, EOS, Energy, NRG. Those are names in that space. I think that's the way to play the energy complex. So even within these different complexes, there are preferred ways and there are not so preferred ways. Solar and wind are in the energy complex. They are, absolutely. But my preferred way to play the AI energy complex is nuclear and batteries, not solar and wind. And then with minerals, lithium's a way to play it. Copper's a way to play it. My preferred way is rare earths. They're more critical, more essential to building out the AI boom than lithium or copper, and also more rare, as the name would imply.
All right. And then I just want to round it off by bringing it back to something we talked about at the beginning, just the overall AI capex. And I want to talk about the AI infrastructure. So we know that number is going to grow. What stocks are should be looking at in the AI infrastructure layer?
Yeah, so I actually, Brooke, to that point, I just created internally, I haven't published it anywhere yet. I just created what I call I'm calling it the AI CapEx 100. And it's a list of what I think are the 100 stocks that are most levered to AI spending, this AI infrastructure spending. We talk about that funnel, we talk about the complex. It's the 100 stocks that I like the best in that funnel, in that AI complex. So I just put that together. I'm refining it. I'm going through it, but that's where I would focus. And we can talk about, there's different layers to it. We can talk about a few names in the different layers. Obviously, I got it right in front of me right here, my list. One specific kind of sub-complex in this AI CapEx 100 is going to be your compute, right? Your accelerators, the actual AI accelerator makers, the GPU makers. That's your NVIDIA, your AMD, more recently, your Intel, ARM. They're developing custom IP. Marvell, Broadcom, they're developing custom IP. Qualcomm, I think, is having a really big moment with edge AI, inference AI. I think they're going to be a leader in inference AI. So these are the sort of names that I think are really, they're definitely DCA names, like absolutely DCA names. Within this complex, there's more like Texas Instruments and Rambus, Astera Labs. Within this complex, I think my favorite high growth name is going to be Astera Labs. I think that company is just really crushing it in terms of connectivity, SoCs, memory pooling for AI clusters, switches and timers and stuff like that. Really like that one. And then, NVIDIA is just, that's the safest bet in the space, I think. You just want to keep DCAing into that. And then a dark horse is Qualcomm. Qualcomm has been a company we've liked for a while. It's starting to wake up because of its inference applications. I think that is the highest growth sector of accelerators in the next few quarters, inference accelerators. And so I think that Qualcomm is particularly well levered to the highest growth segment of this layer of the AI complex. So those are some specific names I'm looking at the accelerator level. Another level of this AI complex, memory storage, right? Memory is massive. We just got news from Samsung and SK Hynix in this space, two big players in this space. Unfortunately, not publicly traded. Samsung is, but it's listed on a non-US exchange. They're hiking memory prices because of massive demand increases from AI. That's rare. Price increases in memory don't happen all that often. So when they do happen, it's a really bullish signal. You're seeing a massive increase in demand for memory. Now prices are going up. That means everyone's going to hike their prices. And that is a really good read through for names like Micron, for names like Western Digital, WDC, Seagate, STX. Seagate just put up a really good quarter. That stock soared and then it sold off a little bit, but that's one I would definitely buy in a dip. I love what Seagate is doing in terms of memory. A big thing here is you have to remember memory and storage requirements are going to increase exponentially as AI gets more and more complex. Right now, it's just LLMs. But what happens when we get to, Sora I don't know if I've invited you to Sora, but Sora AI video generation, like that's crazy cool. That's the future AI. That's the future mode of AI, in my opinion. And that requires a lot more storage and a lot more memory. What about inference? What about when we get to the edge? What about robotics or self-driving cars? Again, a lot more memory, a lot more storage. So names like Micron, Western Digital, Seagate, Pure Storage, PSTG, these are really good names that if they do drop 5 to 10%, they're names you want to buy on that dip. So that's the memory and storage layer. My AI capex 100, I think, is really compelling. The foundry layer, this is kind of like your base layer where the chips are actually made. TSM, that's the mothership, right? All roads lead back to TSMC and the AI boom. That's absolutely one you want to DCA into, dollar cost average into. Global Foundries, GFS, it's a name here in the US that's it's a US based foundry. And if the White House wants to make a play, for making chips in the US, that's the play you got to make. It's got to be GFS. So to me, GFS seems like an obvious candidate for a White House investment, but what do I know? I'm not Trump. Anyways, that's one that I think could win big. Tower Semiconductor, TSEM, Amkor, AMKR, ASE Technology, ASX. These are also in that kind of foundry advanced packaging layer that are in my AI CapEx 100. That if these stocks do drop 5 to 10%, probably good buying opportunities. And then you got the really complex kind of semiconductor equipment layer. This is ASML. They do the EUV, DUV machines, lithography machines. Applied Materials, AMAT. They do deposition and etching for chips. Same with Lam Research. They do that. KLAC, KLA. They do metrology inspection. These are Teradyne. That stock's been on a heater. Really good earnings report last week. My colleague Eric Fry was super bullish on them. Tip of the hat to Eric for getting Teradyne right. They do system on a chip, memory testers, validation, automation, test IP. They're seeing massive growth. So these are stocks that I would look to buy on weakness at the semiconductor equipment level of the AI complex. Then you got your optical and networking equipment stuff. So we've talked about Lumentum a lot on this podcast, LITE. That one was just at all-time highs. It's come in quite a bit. That's one I'd look to buy on weakness, absolutely. Arista Networks is the big dog in this space, 400, 800 gig Ethernet. These are the companies essentially creating the highways of AI data centers so that data can transmit from server to server to server to server to server. Ciena, another name in this space I really like, CIEN. There's a few more names. Cisco's obviously the big dog, but they're kind of boring. I don't think they're doing much innovation here. Corning's interesting, GLW. Credo's interesting, CRDO. They're a really high growth, high torque name. You're looking for some alpha. That's the way to go at the networking layer. And then you got your servers, right? The highways connect the servers, and you need to find the companies that actually make the servers. Dell, SMCI, those are the twin powers in this space. But HPE's in the space as well. Lenovo's in the space. Celestica is doing something really interesting here. They do kind of optics and rack integration. That stock is one of the biggest winners over the last 3 years, ever since ChatGPT launched. So follow the strength. Celestica CLS is a good space there. Neo Clouds, you got CoreWeave and Nebius. We've talked about them. CoreWeave has been really weak recently because it has a bunch of leverage, right? So when times are good, it's going to go up a bunch, and when times are bad, it's going to go down a bunch. That's one that I think, as soon as it starts to bounce, you're going to want to buy that bounce. I really like CoreWeave. You got Power, Monolithic Power, Veritiv with the cooling equipment, Modine with cooling equipment as well. That's another layer of this AI CapEx 100 or AI infrastructure chain I really like. And then you got your power layer, which you kind of already talked about. There, Oklo, Vistra, Constellation, GE Vernova, GEV is another name we haven't talked about there. Quanta Services, Power, PWR. That's a really, really good company that's got a lot of leverage to grid build out for data centers. So that's kind of the quick rundown of my AI CapEx 100 names I like more than others, the different layers I'm looking at. This is the funnel where all the money's going, and this is the funnel that has been the best performer on Wall Street for the last 3 years, and will continue to be the best performer so long as the money's flowing, which I see continuing to happen for at least the next 12 months. So what are we doing right now? We're going through that list. We're seeing what we're underexposed to, and we're seeing what has dropped substantially in the last week or two, and we're buying compelling names on a bounce. That's what we're doing. That's what I think is the best strategy at this point in time for the markets as they stand today.
Beautiful and complex, if you will. Uh, quick follow up to this particular section here, Luke. Before we move on to our breakout stocks of the week, a subscriber question was curious about if there was any crypto plus AI tangents we should be looking into, or that you might have looked into.
Yeah, so at one point in time, I mean, first off, crypto, what is going on? And Bitcoin below, is it below 100? Like, where is it right now? It was 101 when we started this call. Where are we?
A little over 100.
I got 100.3. So I mean, gosh, Bitcoin has been weak, and it's a broader risk off sentiment that's going on right now. Nasdaq is down almost 2% today now. Bitcoin's barely above 100. So crypto is an entire another discussion unto itself. What's going on over there? And then I'll get into the crypto AI stuff. What's going on in crypto land? Well, we're really bullish on uh, stablecoins. And we're really bullish on what we've called internally Project Yorktown, which is essentially this effort by the United States government, spearheaded by Trump and the White House, to standardize, legalize stablecoin usage throughout corporate America. This is an effort that has been underway for several months, which is getting stalled by the government shutdown, unfortunately, but which we think is still very much on track. And so we think that the underlying facts of the crypto market remain pretty positive. You're getting this stable coin, this Project Yorktown thing, this stable coin movement continuing to gain traction, even though it's been stalled by the government shutdown and there's been some drama and delays and whatnot. It's been delayed, not denied. So that underlying fact to us remains positive. Tokenization continues to be a thing. Robinhood is really pushing forward with tokenizing stocks. Coinbase has put up a really good report. So I think tokenization is very much on track as well. Why then are crypto prices struggling? Listen, my diagnosis of cryptos is that they are just the most risk on asset. So when sentiment is very risk on, they do really well. And when sentiment is really risk off, they do really poorly. And right now, sentiment has suddenly overnight, as it tends to, went seriously risk off. And you're seeing cryptos bear the brunt of this selling pressure. The Dow Jones is only down 260 points today on Tuesday, November 4th, but cryptos are down six. Bitcoin itself is down 6% on the day, to its lowest level in several months. They're just levered. They're a levered tech stock. So when tech stocks go up, they go up a bunch. When tech stocks go down, they go down a bunch. That's how you got to look at crypto. So I think that in and of itself explains the recent weakness in cryptos. But again, the underlying facts here I think remain very positive. I don't think this cycle is over, but I would be focused on the stablecoin part of the cycle. I do think that stablecoins, they're actually proving real world value. They do have real world value. And legislation is moving forward to support that real world value spreading, if you will. Amazon to adopt stablecoins, Uber to adopt stablecoins, Amex to adopt stablecoins, all of these companies to adopt stablecoins, and I think they will. The legislation is becoming supportive of that. So, although we've been delayed there, we haven't been denied, I think that remains on track. Crypto AI. There were a few crypto AI projects that were promising, but kind of like the crypto metaverse projects of 4 years ago, they haven't really gone anywhere. And I just think, I'm not saying they won't go anywhere, but I think that at this point in time, there are two growth pillars, two growth verticals within the crypto industry that are actually proving valuable, that are getting out there and proving their real world value. One is tokenization and two is stable coins. And I should have said that in reverse order because first and foremost is stable coins, and the second smaller one is tokenization. The cryptos that we like right now are cryptos tied to those growth verticals. AI is not one of those growth verticals in crypto land that we're very excited about right now because the projects there aren't really doing anything all that exciting. Whereas there are some really exciting projects related to stablecoins. Solana is doing some really, really, really cool stuff. And I think all stablecoins in the future, most stablecoins in the future, will be built with Solana. So that's where we want to be focused. That's not saying the AI crypto space is dead. It's just saying to us right now it's rather uninteresting given the exciting things that are happening in stable coins, and to a lesser extent, tokenization.
Awesome. Now, I don't want to get too far into the weeds here, but something that just to sate my curiosity. So we have this rise in stable coins and, potentially a digital, government digital backed currency. What would that do to the dollar debasement that's kind of currently happening right now?
I think the dollar's screwed, man. I think, and that's going to exacerbate this AI. Here, okay, let's get philosophical.
Okay.
Here's what's going to happen. I'm going to put on my Doctor Strange cape, and I'm going to
Do
look at
the
the outcomes.
yeah.
And here's what I think could happen. We are already seeing in some places in America and the world
Mhm.
AI being painted as a bad guy, right? You're seeing, I just read an article from NBC News about this AI power line that's being built across Maryland, and the Maryland farmers are rejecting it. And you've read the things about power prices increasing around data centers and AI taking jobs and all this stuff. So I think there's going to be a confluence of things that happen over the next 12 months that are going to really hurt the lower part of the K. One is going to be, I don't think rates are going to go as low as some people are hoping. Two is going to be the debasement of the dollar, continued debasement of the dollar. I think the dollar is going to continue to lose value. That's going to help financial assets. That's going to hurt real consumer, real spending, real wage growth. And three is going to be AI driven job loss. I think those three headwinds are going to converge to really hurt the lower part of the K. Dollar debasement's kind of hard for people to wrap their head around. Um, Blaming the Fed and rates when if Trump's guy gets in there and rates still don't go lower and the long end of the curve stays, I mean, people get really confused about the Fed not actually controlling the rates that matter. They think if the Fed lowers rates, their mortgage rate goes down. That's just not how the world works. And explaining why there's the short end of the curve and the long end of the curve, and it's all about Treasury demand and supply, and the long end of the curve is influenced by macro factors. Like, just as I'm saying this, it's kind of complex, so people aren't going to really understand that. But what they do understand is AI is taking my damn job. Or AI could take my damn job. Or AI is causing electricity prices to go up. Or AI is destroying farmland. And so AI is going to become the political boogeyman. I think there's going to be all these factors that really impact the lower part of the K. The lower part of the K is going to get resentful, and they're going to start to hate AI. There's going to be this massive populism backlash against AI, I think, going into the midterm elections next year. You're going to get a bunch of politicians that, as they always do, tap into that populism, run on that hate for AI, promise that if they win, or run on the promise that if they win, they will fight against the AI war machine. I think America First energy that won Trump the 2024 election, is going to become a human first energy in 2026 or maybe 2028. I don't know the exact time, but I think either midterms or 2028, you're going to get America First Energy becomes human first energy. And you're going to get a lot of politicians that tap into that populism, looking to gain power, and they're going to lean into this hate for AI. Those politicians are going to win. Those politicians are then going to enact laws and legislation which handcuff the development of artificial intelligence. They're going to slow the roll on AI because humans first, right? Stop destroying farmland. Stop making our energy prices go up. Stop taking our jobs. They're going to put limits on AI spending. They're going to put red tape back up. They're going to limit the amount of automation you can have in a certain industry. They're going to do things like this to help the lower part of the K. Now, while the intent might be good, the result is going to be disastrous. The result is going to be now big tech is not going to see the ROI on that spending. They're going to pull back on that spending. The AI boom is going to end. The AI stock market crash will arrive. And because this AI stuff is the only thing propping up the whole economy, it's not going to be like a dot-com crash where it's this massive market reset and very little real economic pain. It's going to be like the dot-com crash meets the great financial crisis, where you have a massive market crash meets massive economic pain. And that happens after we have a forced slowing of the AI boom through legislation. That's what I think happens. I think that AI becomes the boogeyman and politicians lean into that. I'm not saying left or right. I think both sides of the aisle could do that. They lean into that with good intent, but the results will be disastrous, and that's how this thing could end. Just a
Yeah,
possibility. Not calling it a foregone conclusion, but just a possibility.
gotcha. Yeah, I mean, it is pretty interesting because I'm kind of seeing it in praxis already. I live in Maryland, and I got a text message from a friend. It's like a Google Doc survey regarding AI data center development in a county I used to live in. So it's already underway.
I have lots of family members that every because they know I'm the AI guy and I always bring it up and I'm always pro AI and I'm like, hey, check out my Sora videos. Check like I'm always that guy at the party
Mhm.
and I have lots of family members that roll their eyes every time I do it. Oh, AI. When is this AI
Yeah,
stuff gonna end? Like the resentment's already there.
it's
Because
baked.
resentment comes from insecurity and a lack of understanding. A lot of people don't understand AI, and a lot of people are really insecure about what it could do to them. People that are comfortable are the ones that are most insecure about it because they know it threatens. Again, it's gonna, like I said, the Fed's driving blind right now, flying blind because of AI. AI is going to change the rules of the economy. People don't like change. There's a lack of understanding out there, and there's a lot of insecurity out there. And right now, it just fetches eye rolls, but once jobs really get lost in mass, once the lower part of the cave really does start to break, those eye rolls turn into full blown resentment. And I mean, that's what politicians do, right? You can't change who you are. You can't change DNA. Politicians lean into those feelings. That's what they do. That's what they're best at. Um, so once that feeling of resentment gets blown up, yeah, I'll bet $1 billion that you'll have politicians lean into that. I mean, look at Mamdani in New York City, right? He's leaning into this youth generation that feels like they've been screwed by the system. And I think they have been screwed by the system. I'm not saying
Yeah.
that's right or wrong, but what I'm saying is there's a feeling, a populist feeling, and you have a politician leaning into that. And what's super interesting is Mamdani's leaning into that, and he's super far left, as you would say in the political spectrum. But Trump leaned into that populism too, and he's super far right. Right? It was the farmers and the middle class Americans in Middle America, the Midwest that felt completely screwed over by globalization and this kind of technocratic society where the coasts ruled everything, the East Coast and the West Coast, and Middle America was forgotten about. And guess what? Trump leaned into that and rode that wave to the presidency, to the White House. So you get people on the right and you get people on the left doing it. It's what politicians do. They lean into populist movements. So I don't know which side is going to lean into this populist movement that's going to arise from mass resentment of AI. But I know someone's going to do it. And I fear that the potential outcomes of hampering the development of AI will be disastrous in the short term, but also in the long term because China's not going to do it. Right? China's not going
Yeah.
to hamper their AI. They're going to continue to support their AI. So I worry about what that potential legislation means for the short and long term of America as a society. But um, it might not happen. I might be wrong about this. I hope I am wrong about this. I'm just saying it's a potential outcome. It's maybe one way this ends.
Yeah, definitely. Yeah, I love that. Maybe in a later episode, definitely dig into that some more. But do want to pivot into the breakout stocks of the week, Luke.
Yeah, absolutely. What did we have up?
WDC is first up.
Well, we already talked about this one. Western Digital, they do memory. They're part of that memory layer of the AI complex, if you will. The stock, I think they had a really good quarter. Stock jumped, as you can see. I mean, this chart is beautiful. Doesn't get prettier than this. Um, it is extended, absolutely. I'm not buying it down $6 after jumping what 20, $30 in a week. But I am buying it on a further drop off. You kind of
Nice.
zoom out, it looks like a completely anomalous run. This is a cyclical stock that goes up and down and up and down and up and down and up and down. But this up is sustainable, I think. This up will last for a little while longer at the very least. If we were to draw a channel on it, kind of draw it off that 200-day break, kind of boom, whoop, draw the channel off that, kind of get up there, midpoint of the channel. I mean, maybe we pull back to this peak right here, 130. That 130 to 140 range looks viable to me. I'm not chasing at 150, but if we come into 140, then it starts to look tasty. I like this one for the next 12 months, but not at 150 in early November. Maybe at 140 in mid to late November or 130 in December. I think that's a good time to buy.
Roger that. And then next up, we have one we didn't talk about too much today, but we've definitely talked about before, Bloom Energy.
Bloom Energy, my favorite. Like I said, I think energy storage plus nuclear equals energy backbone for AI. In the energy storage sector, there are fuel cells and there are batteries. Batteries are cool, but fuel cells are winning all the contracts right now. What is actually being used to provide on-site backup power for data centers today? Fuel cells. Whose fuel cells? These guys' fuel cells. Bloom Energy's fuel cells. So stock has been super duper hot, down 12 bucks today, but only down to 130, revisiting that low from about Halloween around 127. I think this one's actually, I think it's overdue for a bigger pullback than that. When you kind of look at the pullbacks here, you got 86.27 down to 69.8. Actually, let's pull up this part. Let's pull up the max DD on this, the max drawdown. So you can see when this one does pull back in this rally, how big the pullbacks are. Let's get back to this. So back in September, we had a 20% drawdown. Back in October, we had a 20% drawdown. It seems fair that we get another 20% drawdown here. It just does. That's kind of what the stock does. It surges, 20% drawdown, surges, 20% drawdown, surges. Makes sense. You get a 20% drawdown. So you get a 20% drawdown. What does that do? We were at the highs at 142. What is that? Let me do the math on that real quick. So maybe down to 110. So I think this one can fall to 110, which would be pretty consistent. Maybe 115, pretty consistent with that high from back in mid-October. Again, this is one I like for the long term, but I don't like it at 130 than early November. I like it more around 115 in mid-November, late November.
Awesome. Next up, we got one we just talked about, Teradyne.
Tip of the hat to my colleague Eric Fry for really getting early on this one and scoring some big profits for his readers. This stock, I think, is too hot to touch right now, in my opinion, but I do like the long-term value prop on it. You see a very nice breakout, but also, like WDC, very cyclical. Up, down, up, down, up, down, up. I love the break above these highs of 170, 175. I think we got to revisit them. If we get back to 168, 170, call it, and we bounce off that, that's probably a good time to buy the stock. I do think this one is really positioned nicely with its test equipment for AI data centers. Plus, it does have a cobots division, a little robotics division. So that's an upside driver, physical AI. I like this one for the next 12 months. I would like it on a bounce, successful test of 170 and bounce off that.
Awesome. Next up, we got Lumen Technologies.
Yeah, so this company's reinvented itself to be like a pure AI data center thing. The stock's been really, really hot. I've missed it multiple times. I looked at it here, didn't like it, was dead wrong. I looked at it after the massive rally, didn't like it, was dead wrong. I looked at it after it had this big drawdown in April. We did a bunch of dip buying there. We didn't dip buy Lumen, was dead wrong. So maybe you should just not listen to me on this name, okay? Maybe you should just not listen to me. I've been dead wrong on this one so many times, and it has gone higher and higher and higher. And at some point, I'm just going to let humility take over and say, you know what? Maybe the bulls are right. Maybe this one really is a really compelling AI data center play. Maybe it's ready to rip higher. If we want to look at a channel analysis on that, I'll just do that for people because it did, right? You know, there are bottoms here. Boom. It looks like we do have some runway to the top side of the channel. Maybe we get up to, I don't know, 13 bucks. We're at 10.80 right now, so still quite a bit of upside to the top side of the channel. I think we can get there. So that's my short-term analysis. Maybe we go from 11 to 13, but ultimately I'm going to tell you guys, don't listen to me on this one because I've been wrong more times, way more times than I've been right on Lumen.
Appreciate the humility there, Luke. And then we want to close off the inning with form factor.
Yeah, form factor. I like this one. I've liked this one for a while. It had a really strong earnings report. That's why it came on the screener this week. But technically, if I kind of look at it, I mean, we didn't make a new high on this big bounce, and that's a little bit bearish. Okay, this was the resistance right here at what is that 62. We didn't even get to it. Now having a pretty sharp retreat on that. Um, the MAs, I mean, look, it's way above the MAs. This one just feels like it needs to cool off. It needs to take a breather. I do think it heads higher, but I don't think it's close to support. I think we have, I mean, maybe the next levels you could watch for somewhere around here. Like that seems reasonable, 50. But it's actually already 52, so maybe not that far to that. But I think we knife through that. The MA's got to catch up. This one maybe takes a breather at 50 and probably doesn't resume its ascent until the 50 at least catches up.
All right, that wraps it up for our breakout stocks, Luke. Now, pretty long episode this week, but do you think there's anything we might have missed that you want to mention?
Go Dodgers,
Right.
go Yamamoto, go Otani, and go AI stocks.
Definitely. Yeah, sounds good to me. I'm not sure what else I would add there.
No, I think in all seriousness, nice. That was a very dramatic pause slash awkward pause you had there for a moment. The no, all I would add is uh, the apocalyptic crash that's going to kill this AI boom and have dramatic repercussions for the economy is coming. This is not it.
Mm.
It's not going to happen on the heels of a bunch of beat and raise reports that were fantastic, that saw accelerating growth to multi-year highs for some of the biggest companies in the world, that saw Palantir report 63% revenue growth, and its backlog, grew God knows how much, a godly amount. That saw Amazon Web Services post its best growth rate since 2022. That Reddit was another one that had a beat and raise report that was really good. That's the best story in social media, by the way. Alphabet, great report. ServiceNow, I didn't talk about them this week. Great report. Meta, great report. I mean, this is not how it ends. We don't end on the heels of a bunch of beat and raise reports with multi-year high accelerating revenue growth rates, big profit margin expansion, and rising EPS estimates. This is not how it ends. It will end, but not here, not now, not in this way. So from that perspective, recent weakness in tech stocks, I think it can persist, but I don't think it'll persist for much longer, and I don't think we bottom at prices much lower than where we are today. So buy the damn dip. The other acronym is a word I'm not going to use here on our podcast. BTFD, you can figure out what the F is for, but buy the damn dip. I think this is an opportunity, not an opportunity to buy, not an opportunity to cash out, run for the hills and seek protection. That time will come. This is not it.
Gotcha. I think one of my favorite parts of this earnings season was Alex Karp, the CEO of Palantir, essentially telling analysts to suck it because Palantir has just been crushing it.
I just tweeted that actually. I tweeted that out. What was the exact quote? The quote's great. Let me read it for you. The quote is absolutely amazing. Alex Karp said, and I quote, by any normal or even reasonable standard, these are not normal results. These are not even strong results. These aren't extraordinary results. These are arguably the best results that any software company has ever delivered, and that's not hyperbolic. Despite what your analyst friends may want you to believe, because they've been wrong at every price, they're wrong at every single round. But of course, they're persuasive, and as they're not investing their own money. End quote. That's Alex Karp for you. That's a guy I want to invest in. That's a guy I want to support. That's a guy I want to get behind. That's a guy who gets shit done. So Palantir, yeah, BTFD.
There you have it. All right. Couldn't have said it better myself. To sum up the episode, buy the dip. And then make sure to like, comment, subscribe. Ask those questions, please. We'll try to answer them. And that's it for Being Exponential this week. We'll see you in the next one.